Welcome out to episode number 207 of the Trading Justice podcast. It's Coach T from Salt Lake City, Utah, out here with my brother, and we've got a very special episode, as we always say, and I do believe they all are special. Episode 207 is going to be about trading Forex in the currency markets. We've got a few things planned in that regard, talking about trading the pairs and some of the things that happen with volatility and risk and some of those components. Using leverage products is a very exciting thing to do. And there's a lot of things that go into that. In fact, one of the first key components to any trading journey is to decide on the products that best fit your portfolio. And as you learn more and more, you kind of open up the doors to new ones as well, which may be the Forex product for you. Trading Justice is brought to you by TackleTrading.com, as always. And, we're a big part of those communities, Matt and I. And we love the coaches there that we lead and that we have developed. And we love you guys out there that are a part of that. If you've not been active on Tackle Trading lately, get on the clubhouse, ask a question. We'll be going through some of that in our coaches mailbag here later in the show. And, we love hearing from you. iTunes reviews, podcasts, send us an email, send up a smoke signal. However you can get a hold of us, we'd love to hear it. Matt, without further ado, I'm going to bring you in here and say hello. How are you doing today?
Hey, Tim, I'm doing fantastic. It's good to be here on episode of, what are we on, 207?
207, which there are times I feel impressed by that, and then there are times I don't. Like, I think one of my favorite podcasts, Joe Rogan, is on like 950 or something.
Yeah.
So.
It's impressive because of those. Why it's impressive, Tim? Because we actually made it through the first 100 episodes. That's the trials, the errors, all that. So yeah, it's 207. I hope people have enjoyed the podcast and enjoyed kind of what we bring to the table with the pod every week.
I think we've done more episodes of the podcast than there were Seinfeld episodes, Matt.
How many episodes of Seinfeld were there?
I'm guessing maybe over 100. I mean, there was like 8 seasons. 14 episodes.
That must mean we're more popular than Seinfeld. I think that's what it means. So that's the analytical in me, right? It's pure numbers game, man. Pure numbers.
I bet we're more popular than Kramer is these days, but that's a different conversation.
Well, that's all self-inflicted, I would say.
Sure.
with old Kramer. So
it's Michael Richards.
Michael Richards. Yeah, he kind of did that on his own. I don't think we need to debate what he did, but he kind of did it on his own. But I'm looking forward to discussing what's going on in the market this week. Discussing kind of the strategy of the week this week is Forex and specifically day trading in the Forex market. There is a specific cycle in the market that we're going to get into, and then obviously we got I believe it's a new segment, right? Would you rather? Right? Mm-hmm. I think we have a new segment where you and I do a couple would you rathers and then end it on Clown of the Week. So I'm looking forward to this one.
You're in the middle of a battle, the heat of the game. You can't always see exactly what's going on in the playing field. Welcome to the press box, or as we like to call it, the market skyline. Get a bird's eye view of the market's indices, Forex, and commodities here in the market skyline.
Okay, let's start off with a heat map here, Matt. The market skyline is something that we call the overall big picture view of the market. And I'm taking a look at a heat map on the S&P 500. And I want to give you a couple of thoughts here. Number one, Apple Computer had a pretty good week. Basic materials are making a little bit of a rebound. We've talked about the banking sector. As you look at this sector by sector, across the different marketplaces, what are you most interested in right now from a sector perspective?
Well, obviously the market has kind of lost its mind over the last little bit, but technology's been on just an absolute, boom the last little bit over the last 2 months. If you're just looking at the last week, though, and since the last time we recorded the podcast last Tuesday, you're looking at consumer goods. Like Apple is up 1.5 over the last week. Financials are up over the last week. Healthcare stocks, specifically stocks outside of the drugs like, Amgen and whatnot, they're doing fairly decent. Basic materials has came back with your energy stocks doing fairly decent as well. If you're looking for somewhere to kind of shy away from, just given what's happening over the last week in the market, you're looking at service stocks like your discount Walmart, Costco, Target, Dollar General. All of them down significantly over the last week. Your Kroger's down 8.5%. Whole Foods is down 4.63%. So your food, your consumer service companies, your consumer good companies are fairly weak right now. So what's good is your Apples, your Coca-Colas, your Pepsis, your Berkshires, your Bank of Americas, your JP Morgans. Those have done fairly good. Lowe's is up 6% in the last week. Your basic material stocks, led by Williams Company, up 5% in the last week. So in every market condition, Tim, the one thing, a lot of people who are new to the market, they just look at the Dow, they just look at the Nasdaq, they look at the S&P 500, and that does give you a broad range of what's happening in the market. But there's always certain sectors in the market that are doing well and some that are doing worse. So I would look at services, financial, and healthcare and basic materials. Those are the stocks. Let technology come back down a little bit. Shy away from the service companies, especially your food-based companies right now.
I'm still very fascinated with the infrastructure play as well, Matt. And companies like Boeing, Caterpillar, they've been in rips this whole year, had a little bit of a pullback, so they're kind of setting up in some ways. But the banks, technology, I'm with you. They continue to lead the market. That rotation out of Walmart and Costco, really interesting, like you point out.
Very interesting.
Yeah.
Very interesting, because when you roll out of consumer good companies like that are more defensive in nature, you didn't hear me talk about utilities or whatnot. It's because there's not a lot of risk in the market. You're looking at the market right now, and it's still on a tear. You talked about Boeing. Boeing had a little tiny bit of a pullback down to 180, and it looked like a particularly decent setup, and it's just on absolute fire right now. And that's because of the infrastructure plays have done fairly decent over the course of the last 2 to 3 months. And I see them, defense stocks, infrastructure stocks, I see them doing fairly well over the foreseeable future.
Yeah, and it reminds me of an article I read years and years ago, Matt, and I'm going to give everybody out there a pro tip. There's a section of ETFs that we put in our market scoreboard called sector spiders, and they're ETFs that track the different sectors like healthcare and materials and consumer goods. The 9 that I track a lot, and I've added in real estate with it, XLRE, so there's 10 now. They all start with the letters X and L, so X-Ray and Leroy, and then they have a different letter that corresponds to the sector. And the consumer discretionary companies, retail companies, are very different than consumer goods companies. First of all, describe that difference, and I'm going to give you a really cool way to track those two things.
What I would recommend, Tim, for everybody is put them on a watch list. Put your sector spiders on a watch list. We track 9 of them. There are a little bit more than that, but we do track 9 of them. You have energy, which tracks your energy stocks. The not necessarily the drillers. The drillers are in basic materials, which is XLB, but the energy and basic materials really go in line with one another. You have your defensive sectors like utilities, which is bullish right now. You have other defensive sectors like materials, XLB. You have XLP, which is consumer staples. That is food-based companies, and you have XLV, which is healthcare companies, and all of those sectors are some degree of bullish, with really kind of the utilities and staples really kind of leading the charge, with basic materials and energy kind of lagging behind those. And then you have your aggressive sectors like energy and technology. Technology has not had any type of retracement since the first of the year. It's just really kind of been on fire. You have your consumer discretionary companies, think retail companies, think discretionary spending. You have your industrial companies, which has been on a tear ever since the Trump boom. Industrial companies are up about 20% in the time that Trump took office, and that's been in line with what his philosophy is: spend on infrastructure, spend on defense, and those types of companies have deregulation. Those types of companies have been really, really good. And then you have financial, which I categorize more as aggressive. even though historically they have been categorized as defensive. So when you're talking about your consumer good companies, you think retail in general. And you have consumer discretionary, think discretionary spending, think retail stores, Macy's, Dillard's, Target, not Target, but so your retail companies, think spending money on things you don't necessarily need. And then you have your consumer good companies and some of these are service companies, some of these are consumer staple companies. But when you look at them, they're typically spending money on things that we typically use in our everyday life.
I'm going to tweet this out, Matt. I'm going to put out all those different symbols. So if you are following us on Twitter, I'll tag Trading Justice's Twitter and Tackle Tradings and whatnot. But I'll put those sector spider symbols, grab them, put them on a watch list. But there's two specifically, Matt, and I don't know if you've ever looked at it like this, but if you take XLY and you subtract XLP, so it's a cross pair, it's an advanced chart. Gino talks about it in our coaches shows and things, but it's a reflection of consumer sentiment. And when it's going up, it's usually a reflection that the market is going up, consumer goods are rising, and people are spending money. And when it goes down, it's a reflection of the recession. Right now, it's at an all-time high. Things have been good, and it has hit its head all year long. So that rotation out of some of the retailers that you're mentioning, if I see retailers go, that could be a leading indicator to the market, more to keep an eye on as we look at the market Skyline from here.
I mean, honestly, T, also take into account that consumer confidence is at a 15-year high. Retail spending is starting to pick up. Industrial spending is starting to pick up. And these are not, I know there's a lot of caution out there in the market because of, opinions of this or opinions of that. And I certainly do see a tremendous amount of risk out there from a long-term macro cycle. But we've all said that nobody knows when that hits. It takes the Fed a long time to normalize interest rates, and there's so many different variables in that. But when you're looking at it right now, Tim, and you're looking at kind of the price action right now, and you're seeing consumer confidence at all-time highs, yeah, it might be euphoria, and it might be the buyers coming in at the very end before Wall Street starts selling everything. But there's not a lot of indications right now of this slowing down.
Yeah, which we will get to in the charting. In fact, let's talk about the S&P 500 for a minute, Matt. When you look at that chart and you see the strength that we have seen since last week, we've had big upward day one day, but now we're on a pullback, a bullish retracement, which we're coming into a good trend line and whatnot. What do you think of the pull?
I look at that and I say the market is now down for 4 consecutive days. We're currently down 6 points on the S&P 500. You're down over the last 4 days off the highs it did initially hit 2,400 before now it's retraced back down to 2,369. And last week when the market was down 6 points or less than 0.5%, I made the joke that call the National Guard, right? With 4 days down and the market losing 31 points, which is right about 1.5% down in the last 4 days, I don't think we should call the National Guard. I think we should start a war. It's losing its mind. It's down 4 days. The bear market's over. It's now time to start buying. But, in all reality, this might be a buying opportunity, coming back down to where it broke out of on the S&P 500, starting to slow its momentum a little bit. Obviously, you want to wait for that springboard action to get back in on a short-term perspective. What I mean by that is you'd like to see some upward movement in price above the previous candle's high. But that might be a buying opportunity.
Absolutely. Stock prices right now are what I focus on, trading a lot of options on equities, a lot of options on the market. I love that product, but we also we trade commodities as well. And, crude oil has been range bound now for months, really stuck. And, I have a lot of traders who trade crude scratching their heads saying, supplies are at an all-time high, inventories are at an all-time high. Or near there. We keep seeing a real big number when it comes to how much oil is being held, and yet prices don't go back down. What can you equate to the relative neutrality here, Matt? Why can't crude pick a direction?
Well, I think it's trying to find where it wants to go. That's you see these reasons that basically you were talking about inventory, you were talking about supply, you were talking about these. And these were all really kind of similar when crude was at $27, Tim. in terms of us being at production and at weight in terms of how much crude we can hold. Obviously, we are energy independent, more so now than we have been in recent history. But I'm looking at crude here, and I'm going to focus on the price action. I said last week that a close above $55 a barrel would signify a significant buying opportunity. And I don't see anything in this chart to say that's not the case still. Crude came down a little. It tested above it tested that $55 barrel last week, but it never closed above that. And that is the key point here. As a buyer, you would want to see that close above that. But even this week, when you're looking at the price action this week in the marketplace, you're still seeing a higher low, despite the fact that you are in a neutral trend. You're seeing a higher low form. You're seeing a test in that it's currently at $53 to $54 a barrel. And if that does take another run at 55, I think it could certainly break out above that. But you can't be a buyer on crude underneath $55. It's just trying to find where it's want to go. And quite frankly, you can't be a seller of crude until it breaks out of its range bound. So the best way to play crude right now is the same way that we've been doing for the better part of the last year and a half, and treat it as a long-term investment with USO and write out cover calls against it. Until that range breaks, there's no reason to get directional unless it breaks out of its range. Until then, cash flow.
I agree. And, if you're new out there, I think, what we just heard here, and I think it's important, I'm going to say it again, cash flow is king. And we're going to be talking about speculation trading here in a little bit, Matt. And I love Forex trading, but when you're new, you got to build a cash flow technique, a naked put, a covered call. I know if you're a veteran out there, that sounds kind of boring. But I will tell you the same thing I told one of my students that emailed me, Matt. He said, Tim, I'm making money with covered calls, but I'm a little bit bored. And I said, okay, go for a walk, read a good book, stay bored. If you're making money, don't make this complicated. The markets are exciting, but that's not the primary purpose, is to be excited. Making money is the primary purpose. So I agree with you on the crude oil call there.
Listen, real quick on that, because it's an important point. If you're trading as nothing but a roller coaster on, whatever amusement park you like to go to, you're probably doing it a little wrong, right? Trading and investing should be like watching paint dry. It should be conservative. It should be simple. It should be boring at times. Watching 3% growth in your portfolio on a monthly basis, I would say it's actually quite sexy. So continue to be bored is what I would suggest. And if you want to get aggressive, get 80% of your portfolio in cash flow strategies and spend 10 to 20% learning how to day trade currency, which we're going to talk about in a little bit.
I agree. It's all part of portfolio design, and really at the core of any portfolio, though, is the market Skyline. I mean, the things we do here at the beginning of the podcast or the beginning of a coach's show, it's what we do every day. We look at these different products, and it's an important part of being a trader is to get, size up the market, Matt, as part of your routine. That being said, metals are definitely on fire lately, but not in a good way. Somebody lit them on fire. They're dropping now. Yeah, pullback here.
Burning.
Sharp on gold and silver. Obviously tied to currency, obviously tied to perception of where to put your money in terms of risk and whatnot. Do you see the pullback in metals as something short-lived, or do you think we're heading back down towards lows?
Yeah, difficult to say. We talked last week about that trend on gold specifically slowing its momentum, but neither one of us thought that the last week would have transpired, especially when you're taking into account the dollar. The dollar initially was hitting up against its head against resistance levels, and it attempted to break through those levels, and that's what led to initially the commodities going down. But then the currency came right back down underneath that 102 level, which is the resistance level, and that's right where it is right now at 101.81. So my projection on the dollar still maintains. I see last week as a little bit of a fake out, although it's trying to do it again. So I'm a little off on that projection, but I still see a little bit of short-term weakness in the dollar. And typically, Tim, that would lead to a buying opportunity in commodities on a short-term basis. I'm not seeing that in the trend. I'm not seeing that in the pattern. If it would have held its head above 1225 on gold, that might have been the case, but it didn't. It broke through that level of support with some gusto. I could see gold going down another 15 to 35 points between the 1200 and the somewhere around the 1180 era, given the fact that we're seeing some momentum to the downside. On silver, I'm seeing a little bit of the same movement, but it didn't break any major support level. I'm looking at a strong support level at 1730. Silver's currently at 1752, which means if we start to see slowing momentum at those price points, that could be a buying opportunity in silver. I'm a little bit more leery of gold right now, so if I am looking to get into the commodity, I think the trend at 1730 to 1750, if we start to see that move back up, that might be more of a buying opportunity than gold. I'm still not a buyer on the dollar.
Got it. And the thing about the dollar's strength right now is it's so much tied to the Federal Reserve, like we have mentioned so many times. And there's this perception about investing out there, Matt, that comes from big money, that when interest rates are going up, it's a reflection of strength in the currency, which is the traditional economic model. And so money goes into the dollar, money goes into the currency. It comes out of alternative investments like gold. And they call this intermarket analysis. So some correlations, Matt, are direct. Some are inverse correlations. And the dollar and gold tend to have an inverse correlation over the years. This rate hike was not unexpected, but I don't think as many traders thought it was going to happen short term, like you're now seeing the probability priced into the market, 90% chance of a rate hike on March 14th and 15th. What do you make of the news? And Yellen in front of the cameras recently talking about raising rates.
Well, that's obviously what I mean, even before they spoke last week, it was widely considered March was going to be an interest rate hike. And the concern that people have is are they going to change from 3 hikes this year to more hikes this year than just the 3 that was projected? And so with when they came out a little hawkish the other week, it caused the dollar to move up, it caused commodities to move down, and you're absolutely right, that intermarket relationship usually does play out. When interest rates are starting to go up, you have basically more demand in the dollar because you get paid a higher interest rate on the dollar. You have less supply because you have less borrowing. So dollar typically goes up in that capacity. Commodities typically go down in that capacity. And that's why over the last 20 years, commodities have been preferred to than currency, is because the interest rates for the last 10 years, and really since the crash from 1999 to 2002, where interest rates were at the top end at 6.5%. But then over the course, you've seen lower interest rates on the lows and lower interest rates on the highs if you look at the market cycle, which means the dollar has been a little bit of a laggard over the last 20 years than commodities have. I think anybody over the last 20 years that would suggest on the currency versus the commodity would have lost a significant amount of money because as interest rates go down, the commodity goes down and so on and so forth. So I'm looking at this situation right here and I'm saying, okay, is the Fed going to raise rates aggressively? And if the Fed raises rates aggressively, then the dollar should appreciate in value. But a 1/4 point increase is not an aggressive rate, Tim. Even if they came into the 1.5% this year, I don't think that would be aggressive rates. You have to get into the 3.5 to 5.5% to get into any semblance of normalization of interest rates. When they normalized the interest rate in 98 to 2000, it went up to 6.5%. When they normalized the rate in 2005, 6, and 7, it went from basically a 1% interest rate to a 5.5% interest rate. And when they started normalizing the rates this time, Tim, it went from a 0% interest rate to now we're currently at 0.75. But even if you project it, you would have to say it gets into, that 3.5 to 4.5% just to even have a semblance of a normal interest rate. I mean, there are now generations in America that do not understand what a normal interest rate is because they didn't grow up in that environment. And so I do not think that a 1/4 point here or a 1/4 point there is going to destroy the market, nor do I think it's going to impact the dollar versus the commodity that much. They would have to normalize interest rates. So, do I think they're going to raise in March? Yes, I do. But I would like to see what that statement says to see what if they come out their projection of 3 to 4% interest rate hikes, not percent, but 3 to 4 1/4 point hikes throughout the rest of the year. If they come off that and they come out and they start, and they were tickling this a little bit, Tim, the other day. They were hinting at it the other day about how they've basically maybe they've waited too long to raise interest rates, right? They said maybe they overshot on inflation. But everybody in the world has already known that. If you go to the grocery store, the Fed overshot on inflation, but they would have to aggressively raise rates to come off that commodity currency correlation. And I don't know if it's in this Fed's DNA to be able to normalize the interest rate to the point that they have to. I just don't know it's in.
Well, I wonder what is in the plans from a long-term perspective with the Fed. I mean, that could be a whole conversation over time, but I got to tell you, I check the news every day, and I don't dig into it, for hours and hours, because that's not the point being a trader. You're supposed to get the information, move on to making your decisions, and it's always the Fed this, the dollar this, rate hike this, rate hike that. What they're going to do here, there. Then it affects international currency markets, which gets us into what will be our feature presentation, Matt, and talking about Forex trade. If you're watching the markets anyway, and you learn how to play individual stocks, eventually you're going to start looking at the big picture. And it's a natural evolution of what happens to a trader. Let's say that all you ever wanted to do was trade your same 10 stocks over and over again. Well, eventually you're going to want to look at the overall S&P, yep. And then you look at that every day and you're like, okay, why'd the S&P go up or down? Well, okay, the commodity market, the currency market, these things are all tied together. And the biggest market in the world is money, and it is the dollar and the relationship of the dollar to all of these other things. As I look at the big picture in the market, some of the key things for this year, what happens in China with their economy. I've seen some headlines coming out recently about China's economic outlook is slowing. They're, instead of this or that, they're dropping it down to a few percentage points.
Tim, you can only build so many fake cities. Okay, at some point that will have to slow down, and China's going to slow growth as they get bigger. Anyways, I'm not going to get over panicked.
You're speaking to a former champion of Sim City, so you can build as many fake cities as you want to if you're a gamer, right? There are many.
This is true. You can. Stronghold Kingdoms. There you go. Shout out to Stronghold. Right. You can build as many cities as you need. China is the real life 2017 version of SimCity.
Oh
from
man, that old.
You got to put your airport. You got to build your airport. Create economic activity. Basically, that's what the U.S. economy is. It's
infrastructure,
right?
Got to plan the roads.
Don't get us started. Yeah, don't get us started on that. But you know what? These markets are correlated with one another, and even if you don't trade currency, you should understand currency. Even if you don't trade commodity, you should understand commodities and how they behave. If you don't, even if you trade the same 10 stocks over and over, obviously you're going to want to know those 10 stocks more than anything else, but you're going to want to have an understanding of the big picture as well. And that's why we bring you the Market Skyline every single week. And we'll be right back after these kind words from producer Cam, the sultry voice. He is competing with you, Tim, on the sexy voice of the podcast. And I'm kind of feeling like a little left out here, but we'll be right back with the feature presentation.
Trading alone again. This isn't what Wall Street promised you. Day in, day out, cover calling and naked pudding, all by your lonesome. Now that's sad. A special kind of sad. Alright, first off, get a tissue. And secondly, if you're gonna cry, do it in the shower. That way nobody can tell. And third, get to tackle trading, where the people are the coolest, the coaches are the most available, and the trades are sexy. Not kinda sexy, but very sexy. Thank you, ladies. Tackle Trading, the home of the most vibrant community on the World Wide Web. Come kick it like Freddie Adu. And without further ado, your featured presentation.
It's a competition these days now, Matt, that you have artificially created between Cam and I. So I know that you're enjoying this.
It's Chris. Chris started this.
Chris, I know you listen to our podcast, and he's got a couple of young men that we call nephews that are adults now, and they want to start learning this stuff, Matt, which I find exciting, giving back all the time. So I'm going to challenge those young men.
Tell them about the text.
Well, I got a text, and I was in bed and literally almost falling asleep. And I'm an old man. In many senses, I go to bed early and I wake up early. I'm up at like 5 o'clock in the morning, working, writing, doing my process. I have my own thing. And Chris sent me a text and just said, "Hey, I got to tell you, I love your podcast. Don't listen every week, but when I can, I really enjoy it. You guys do a great job." And I appreciated that. It's cool to know that, big brother. And Chris is awesome. He's a successful businessman. He's an entrepreneur. He's a great person, father, community leader. We love him. And so knowing that he is listening, it's kind of cool, And then number two, he said, my sons, my two oldest sons, Deke and Ty, we want them to learn how to trade. How do I get them started? And Chris, I'll call you as well as soon as we're done here today. But what I'll tell you is simple. Get them over to Tackle Trading and have them register and have them start going through the tutorials. There's a ton of content over there. There's a program called the 7 Steps to Trading. Now, all of this they can just access literally with a free membership, a rookie membership. So if you're new out there and you're like, I want to get my family member or somebody into this, but I don't know if they're ready for everything like a pro membership offers or going into a paid mentorship or class yet, Matt. That's a commitment, right? An important one and a big one and a smart one. But if you are out there and you're thinking, I want to give my family member a tip, I would say that 7-step program is a good thing to start with, don't you think?
Yeah. I love the fact that you're selling your nephews here. I love that. You're showing your greed side a little bit here, Chris. We'll take care of the nephews. I just love how you went into pitch mode. It was straight into pitch mode.
My passion for our program is a pitch.
I'm sorry. It was just too good. It was too good. But yes, Chris, we'll definitely put them on a map, and that map will be very similar to one that we put others on as well. Going through the Tackle 7, attending the coaches shows, watching the videos, getting accounts opened. Both of them are 18 years old, respectively. Ty's a little older than that. So that they can get up there.
First of all, the way I teach anybody, whether they come to a mentorship from halfway across the world or whether it was, your nephew, same way, you make them aware of what the market is.
No, it is. I agree. And you have to have skin in the game. There's no doubt about that, or you'll never do it to the point where to be successful. Here's what I love about that story, Tim. You and I started this journey 12 years ago. And, both of us college educated. I just graduated law school, and we made a decision that we wanted to learn how to invest and trade. And we took classes, we took mentorships, we eventually became coaches. And, for the last 3 years as a public speaker, I've told people that the decision that you make to want to educate yourself in terms of investing and trading, it's an amazing decision, but it's not just about you. It's about the people you care about. It's about the people you love. It's about your community and your society. It's bigger than just you. And you don't know who you will impact. But, you look at this, the text you got last night from Chris, and it's about, and all of a sudden it's like, okay, I want my sons to, Chris is an entrepreneur. He's a small business owner. I want my sons to learn how to invest and trade. And I just think that is so amazing that, it's leading into that. The only question I'm going to ask Chris is, how the hell did it take 12 damn years to get to that level that you wanted this? Damn, we've been putting out this podcast for 3 years now. This should have been like on episode 3, but I get it because episode 2 and 3 weren't very good. No, it's awesome. I think it's so awesome. It warms my heart. And I look forward to helping Ty and Deke.
Well, it reminds me of stories I tell all the time about different people in my life that have come and learned how to trade, from me. And sometimes it takes people a long time. I have many friends, Matt. One I'm thinking of very specifically that, he needs to learn how to make more money, and he has always needed it. And he's been pretty dead broke for most of when I've known him. And he wakes up at 4 a.m., goes, works a job he hates and all that. And he never asked me to learn this stuff, even though he knows everything I do. And he knows, my students, he knows the classes I teach. He knows I'm an expert. Sometimes it takes whatever it is for them to cross that last 10%, which is why I said what I said.
You can't force
those young men. Yeah, if they're excited about this, it's great. But they do have to show some initiative. And young men, if you're listening, I will tell you, you'll have support and you'll have help and you'll have team. But you got to put effort in to anything if you want it to be successful. And that is an important part of this.
No, I agree with that. There's no doubt about that. I just wanted to make fun of you.
Well, nothing's new. That's as old as the Forex market, Matt. It's been around for a long time.
Hey, that was a great segue, by the way. Look at that. That segued into the Forex market. But yes, that's what we're going to be spending the next few minutes talking about is currency trading, and specifically, Tim, not investing in currency, not swing trading currency, not position trading currency, but day trading currency. And what I'll say about day trading currency is this. It's widely popular. It's blown up in popularity over the last 15, 20 years because it's probably the best day trading vehicle in terms of covering any type of risk out there. So in looking at this as a day trading vehicle, what people have done over the last 20 years is they've shifted from day trading in stocks and options to day trading in a marketplace that never shuts down, and that's futures and the Forex market. So Tim, why is it that people have rotated? They've shifted over the last 20 years.
Robert Kiyosaki talks about it's OPM, other people's money. Forex is one of these products, and it's leverage. It's that with $100, you can control 5,000, and that's in the U.S. market at 50-to-1 leverage. So really it comes down to a simple thing. People feel like they can get more bang for their buck. They can go after it more aggressively, and leverage is a big one. Mm-hmm.
So let's identify where leverage can go then. Okay. So let's identify how far $1,000 goes. Okay. If you have a trade of $1,000 in the stock market, it is leveraged at 2-to-1, which means you basically control $2,000. So your investment is $1,000, you control $2,000. Then you have the options market. And the options market is leveraged about 10-to-1. So instead of buying the stock, you buy the call option. And you control the stock. And that means instead of $1,000, you actually control.
So let's do some math on that real quick. So let's say you said 1,000 in stocks, you're controlling 2,000 worth. Let's say you buy $100 stock that moves $2 a day. You follow me? That means you can get 20 shares at $2 a day. So your position may win or lose 20, 40, $50, right? On your $1,000.
Yep.
Okay. Yeah. And then options, you could put in, let's say, 5 to 8 option contracts at an at-the-money short-term option that'd be very leveraged and aggressive.
Yeah. If you're putting 1,000, if we just keep the position size the same, $1,000 a trade, right? And let's say you put it, so you're controlling $1,000, you get 20 shares, whatever it is. Let's say you can make $40 in the stock market. What that means, you can make $400. So
the options market, you can make 400. You could also lose 400 or 1,000.
Lose. Yeah. And that's very, very good point, because with leverage, it's the proverbial double-edged sword. If you position size too much, then that's going to, yes, you can make more money, but you can also lose more money, which means in any one of these leverage trades, you need a position size small. It's a very simple equation. More trades, less position size in leverage. In the futures market, you're leveraged at 25-to-1 on average, which means you can control about $25,000. And in the Forex market, you're leveraged at 50-to-1 in the U.S. For our listeners outside the U.S., check your national rates. A lot of times they're 100-to-1, 200-to-1. They can even get up as high as 400-to-1, right? But in the U.S., you're leveraged primarily at 50-to-1, which means that same $1,000, Tim, controls $50,000 worth of capital. And so a lot of people will go over to the currency market for a couple reasons. Number one, you can do more bang with your buck. So you can make trades as low as $20 in micro lots. You can make trades with thousands and thousands of dollars in standard lots. But it's in a vehicle that is absolutely for everyone. Number one, it's a vehicle where you can do more bang with your dollar. Number two. Number three, the reason I think a lot of people really enjoy the currency market is because there's actual less things to analyze in the currency market. You don't have thousands upon thousands of stocks, and you don't have 40 to 50 different option strategies, and you don't have all these different commodities. You just have your 6 major pairs is what you have. You have the dollar against the other 6 major currencies, and then you have a few cross pairs that you analyze as well. So you have your major currency pairs, which is a dollar against any major currency like the euro, the pound, or the CAD, or the Swiss, or whatever the case is. Then you have your cross pairs, which are your major currencies that do not consist of the dollar. So you have less things to analyze, which means it's easier to find trades. You don't have to spend a lot of time scanning for different stocks because you're just looking at the same currency pairs each and every day. I also believe that a lot of people have gravitated to the currency market because of the faith of stop losses. When you're trading stock, Tim, and you hold a stock overnight, that's where your risk is. Your risk isn't when the market is open. You can do whatever you want if you own a stock. The risk is when the market is closed. And so for day traders in the stock market, they would have to close out of their positions before the end of the trading day because of, potential to news one way or the other. That brings in an additional, variable in the equation. So the day trader's like, no, we're going to close out of all positions before the end of the trading day. And that's stock or options. But in the currency market, Tim, you don't shut down. It's a 24/5 market. The only times it closes is 5 p.m. Eastern Standard Time on Friday when the New York banks close, and it reopens Sunday afternoon when the Sydney, Australia banks open. So other than those 2 days on the weekend, it's opened 5 days a week, 24 hours a day. And the beauty of that is not necessarily that you can go trade for 24 hours a day. That's insane. The beauty is this, Tim. You can trust your stop loss. So if you do have a day trade on, you don't have to automatically close it. You can adjust the stop loss, let your stop loss do the action, and you can go live your life and whatnot. Because of these reasons, day trading, and specifically the Forex market, has exploded in popularity over the last 20 years. And I see it even getting more so in the future as well as more and more people understand what currency
There's
really
no question about that. And I will say that. I mean, the things that come to my mind when I think of Forex day trading, many of the stuff we've already talked about, leverage, OPM, access to capital. But another one is the 24-hour-a-day market, Matt. And one thing that some new traders really like about Forex day trading is that you can do it anytime during the day. The only time really the markets close is Friday after the New York banks close until Australia opens up on Sunday afternoon.
Yeah, that's really the case. So, and also because of the way the currency markets behave, there's a specific market cycle around the currency market. And there's cycles in everything. A cycle is just a pattern that continues itself over and over and over again. So when we're looking at that specific cycle, Tim, it is a 24-hour cycle. Now, Tim, do me a favor and spend a moment or two describing what the cycle is.
Well, it's not that hard to really think about when you just think about the fact that currency is going to be driven by banks, Matt. And banks are the ones who hold the money, move the money, make international trade, facilitate international loans and banking and all that kind of stuff. And so when the bank opens in a certain country or the banking system gets active in that country, Forex is going to become more active. And so that particular currency becomes more active. When you think of the international date and time, Australia, Sydney, Australia, is the first international banking center that opens up and pushes currency trade because their Monday morning is everybody else's, Sunday afternoon in the Western Hemisphere, I should say. So you go from Sydney a few hours later, you then open up in Tokyo and the Japanese markets, and Tokyo is such a central piece in the Asian markets that it will start pushing. Now, by the way, you're trading all the currencies at any of these points. But whenever that bank opens, that particular type of currency will have an increase in a thing we call volatility.
Well, and let me explain why that's the case, okay? Because you have 4 major bank opens throughout the world. And the first major bank that opens up is Sydney, Australia, and that opens up, and I'm going to do Eastern Standard Time, about 5 p.m. Eastern Standard Time. Then 2 to 3 hours later, depending on daylight savings time, you have to make Japan
Yep.
or Tokyo open up, and that opens up at 7 to 8.
Well, and then even
Eastern
though
Standard Time.
Shanghai is next,
Then
it's not one we trade. So we'll do London next.
No, it's not, and it's not one we trade because nobody trusts the Chinese currency yet. Now that might be different in the future, right? But for right now, we don't trade that one. The next one that opens up is actually Frankfurt, Germany, and it's not considered a major bank, but it is the European Central Bank, which I do consider a major bank, and that opens up at 2 a.m. Eastern Standard Time. Then an hour later, the Bank of London opens up at 3 a.m. And then a few hours later, the New York banks open at 8 a.m. Eastern Standard Time. Because there's always a bank open, you always have currency transactions. See, that's the difference between the currency market and every other market out there. Every other market out there that you trade and invest in has an exchange where the order goes to this exchange. You have the New York Stock Exchange, the American Stock Exchange, the Chicago Board of Options Exchange, the Chicago Mercantile Exchange, right? Currencies don't get traded at an exchange. They get traded through the banking system, the banking cycle. Because there's a bank open at all times except Saturday and Sunday, you constantly have currency transactions that are constantly happening. And now, you were getting to how the market cycle kind of behaves itself. Just because you can trade the Japanese yen 24 hours a day doesn't mean the Japanese yen doesn't sleep. Just because you can trade the euro 24 hours a day doesn't mean the Europeans don't sleep, right? Currencies are going to behave differently in the market cycle depending if that bank is open versus when that bank is closed. When that bank is closed, like think about it right like this, Tim. This is an analogy I've given before. If it's 5 p.m. Eastern Standard Time on Tuesday, right? We're sitting here, we're recording on Tuesday. It's 5 p.m. Eastern Standard Time. In London, it would be 10 a.m. No, excuse me, it would be 10 p.m., right? So at that time, you can talk about the Swiss franc, the euro, or the pound. Let's say we're sitting in New York and it's 10 p.m. in London. We can trade the pound, we can trade the euro, we can trade the Swiss franc. But what are the traders of London
They're having
doing?
a pint.
They're
They're getting ready for bed, and
having a pint. Like people always say, Tim. They always say, "Oh, they're probably getting ready for bed." I'm like, "Nah, you need to know a few more London traders, right? They're at the pub. They're getting their dark warm beer, and they're drinking away.
They would not take offense to anything we said, but the idea of them drinking warm beer, they always drink it at cellar temperature, Matt. And it's old school. We're not going to get into absolutely
cellar temperature. We'll do the beer podcast later on. We'll put the beer podcast right behind when we do the God podcast, the religious podcast, and the all political podcast. We will do those right in order, back to back to back. So whether they're drinking a warm beer, a cold beer, a cellar temperature beer, whatever, an ice cold beer, they're not trading, right? And because there's nothing happening out there, because there's no economic reports, everything is just. And so what's going to happen is, despite the fact that you can trade, a lot of times it just kind of flatlines, right? It just kind of goes to bed, right? But at 10 p.m. in London and 5 p.m. in New York, it is 8 o'clock in the morning in Sydney, Australia. And all of a sudden, at 8 o'clock in the morning, it's Sydney time, the birds are chirping, the traders are trading, the bank is taking transactions, and most likely there is some degree of economic report that comes out in that time frame between the 8, 9, 10 o'clock hour in Sydney to drive price action one way or the other. And that's what really kind of creates this market cycle, is the banks taking transactions in the international trade as well as economic reports that are priced into the market. Most economic reports around the world, not all of them, but most economic reports around the world come out in the morning, at some point in the morning. For example, for like tomorrow, right? Tomorrow's Wednesday, March 8th. The United States dollar is announcing ADP, non-farm employment change, and they announce it at 8:30 in the morning. The next day, the U.S. is announcing unemployment claims. It's at 8:30 in the morning. On Friday, you have the unemployment rate, and that comes in at 8:30 in the morning. The British pound manufacturing production, 4:30 a.m. in the morning, 1 hour after that bank opens. The European minimum bid rate actually comes at the end of their trading day. But when I'm looking at this economic calendar here, I'm seeing a high majority of economic reports come out at the beginning of their market hours, whether that's their banking hours or their stock hours. And so the currency will behave very similar in banking hours versus non-banking hours. In banking hours, we typically see at the beginning of the bank, we typically see a trend develop, whether that's a bullish uptrend or a bearish downtrend. And that trend, as it develops because trade is happening. It develops because economic reports happen. But when things start going in motion, most of the time they will stay in motion until something else changes to change the behavior or the pattern of that currency. And that would have to be another bank open or another economic report, around the world. But most of the time, it just continues to move in the direction. So what we like to do, and this is a strategy for day trading, what we like to do is we like to take this banking hours. We like to master the banking hours. We like to identify whether whether that currency goes up or down based on the time frame of that bank opening up. We will buy or sell based on that. And that is a very, very good traditional standard day trade for a lot of currency traders.
What's one warning you would give a new Forex trader, Matt?
Stay away from economic reports.
Until you know what you're doing, don't trade the data.
Until you know what you're doing, don't trade the data. It's tough. It's volatile. It widens bid-ask spreads. I mean, 5 years ago, I would probably start trading economic reports because they're fun and they're volatile. But they're just aggressive, and I've seen people get screwed over on bid-ask spreads. It's better to wait till the data kind of subsides a little bit, and then you trade the secondary price movement. I would say stay away from economic trends. So warning signs: sharks are swimming in the water. Stay away from the first 15 minutes after a major.
I would also give a
report.
tip out there that trade maybe one currency a lot before you start doing a lot of different ones. I like it when somebody tells me, you know what, Tim, I'm focused on the euro dollar cross or, the Aussie dollar cross or maybe 1 to 3 currencies. I really, that always gets my interest, piques my interest in there. So keep it simple. If you don't understand and calculate proper money management and position sizing, it doesn't matter how good your entry points are. You can be the chief economist for an entire country. You'd still lose money trading. Okay. You cannot over leverage and get away with it for very long.
1%. 1% position size.
And this is where some traders, Matt, just don't take it serious, right? And this is where I heard a statistic once that should give everybody fair warning out there. And that's that 90% of Forex traders lose. 10% make most or all of the money, right? And if you want to do this part of the business, not everybody has to trade leveraged Forex day trading stuff. But if you're going to do it, your goal should be to be in the top 10%. And that all comes with discipline, business design, and money management.
When you say 10% of Forex traders make money, I think it's actually higher than that, but I also do believe that money does exchange in every transaction in the currency market, which means 50% of people make money and 50% of people lose money. But it's the 20% of that 50% that have the education, the skill set, and the experience that makes money over time consistently.
Well said. And I would also say that 100% of people who do it right build great businesses and can profit. I would agree with that. So I think the reason why you hear stats like that, quite frankly, is to let new traders know you can't mess around. This is not a game, and if you treat it as such, you will quickly be out of that game, and that's the nature of it. So Forex is an incredible product, Matt, and one that I definitely think can fit the role of almost anybody's trading portfolio. And so I think maybe just the warning there, whatever number it is treat it serious, guys. I mean, don't treat Forex like somewhere where you're just going to throw some money in and hope it works out. If you want to build this out, and what's fun about this, Matt, is every now and then I'll find one of my traders that I'll talk to a couple years after they started, mentorship or programs and whatnot. And they started out with stocks and ETFs, and eventually they just kind of find their way into the more leveraged futures or Forex or options markets. So there's a journey.
There's a journey. It's an evolution. There is. It goes stock options, futures, currency, or stock options, currency, futures. That's kind of the journey it takes. Not a whole lot of people start their journey in currency unless they are at a class being taught it or whatnot. So it is a journey, and that's kind of how my journey was. It was stock options, Forex, and then futures, and then yours was stock options, futures, and Forex, right? You learn to trade it all. There's no doubt about that. But coming back to the currency cycle day trading, a couple things about that. Focus on the bank open trade, right? That's the trade I would focus on initially. Identify the price movement after the bank opens up. Make sure that if you're going to trade that, though, that you understand that a lot of that is driven through economic reports. And so make sure that you understand when the economic reports are coming out. Don't get in front of them, get behind them. Okay. And I hope everybody understands what I mean by that. Do not over position size. Most currency traders, even the pros, position size very, very small. So if you have a $100,000 account in your currency account, you're typically trading $1,000 to $2,000 positions in your portfolio. If you have a $10,000 account, typical risk is 1% to 2% as well. So just do the math on that. But more trades, less position size is what I would say.
Get to know people like Keith King and Jeff Crystal, and obviously listen to the podcast and learn from traders. Matt, there's a great discussion going on in our clubhouse all the time about Forex, the Forex report. Yeah. So you've got a leg up if you've got a community as well, because a lot of these little things we're talking about, these traders have been there and done that. So last tip.
Nope, I agree. I would agree with that. Watch the Forex report every single week. But guys, even if you're not a pro member of Tackle and you don't get to watch the Forex report, you can always sign up for a pro membership of Tackle by using Justice15 in the coupon code as you test it out for 15 days. You can look at those Forex reports. But out there, even if you go check out Tackle Trading YouTube or at the Tackle Trading website, you type in Forex Trading 101. About a year and a half ago, I did 4 lengthy video series on Forex trading, what it is, how to do it. Too. So you got those Forex. Also, yeah, they were good. They were good stuff. Also, we've done podcasts with Jeff Crystal that you can get over at tradingjustice.com as well. We'll be right back with Would You Rather from Trading Justice.
This is Trading Justice. Check out our sponsors, tackletrading.com, where you'll find comprehensive trade information, including the current state of stocks, commodities, Forex, and economic reports, and much, much more. While you're there, you can download the 7 Steps to Trading Guide, Tackle Trading's proprietary and exclusive PDF guide on trading the markets, and start maximizing your trades.
All right, we're back now with the Trading Justice Podcast, episode 207. As always, guys, if you like the podcast, do not hesitate to tell somebody else about it. We've grown the podcast organically through the help of the best part of Trading Justice, and that is you, the listeners. I hope you have enjoyed this podcast so far, and I hope you share it with somebody on Facebook or Twitter or Instagram. And if you really like the podcast, go over there to iTunes, give us a nice little 5-star review. We appreciate reading those reviews as we did last week as well. Tim, we got a new segment here called Would You Rather? And the Would You Rather, you and I have not talked about these. The Would You Rather revolves around you asking me a Would You Rather question, me asking you a Would You Rather, and then us discussing it. So I got one for you. Snapchat just came out, right? A few days ago. And, basically, I was a don't buy Snapchat type of guy, right? I said many times, wait, right? So I'm going to give you a would you rather regarding Snapchat. Would you rather invest in Snapchat or get punched in the face? No, I'm kidding. That's not the one. Here's the one.
Well, here's the one. It may feel like getting punched in the face if you were an
investor in Snapchat on its IPO. You deserved to get punched in the face and kicked in the groin at the same time. But that's what greed does. And by the way, Snapchat might be a good buy at some point, just like Facebook was a don't buy for us, and eventually it became a big buy for us. Snapchat certainly could be there, but it was just overvalued coming into the hype. So here's the question I have for you. Would you rather invest long-term in Snapchat or in Twitter? So you got Snap as SNAP, and you got Twitter, and everybody else. The listeners here, we're going to put some of these would you rathers in the clubhouse at Tackle Trading. So we're going to do these would you rathers in the clubhouse every time we do this segment. Would you rather invest in Twitter, TWTR, or Snapchat?
First of all, I will take Twitter, and I don't have to dig too much into the fundamentals of the details. Snap has publicly said they may never make money. Twitter's at least profitable, right? I know that they've been under pressure.
Amazon didn't make money for 20 years.
I get it. I understand that. But Twitter has also been the target of takeover bids and rumors in the last year. I think there's interest there, and I think the platform has a unique.
I think they're both buyout candidates. And I'm not trying to. This is your would you rather. So
I'll take.
You would rather take Twitter. I would rather touch neither of them. But if I had to, because that's what the would you rather was, I would probably take Twitter right now.
Okay, so would you rather? I got a good one here for you, Matt. Would you rather? One of the two following scenarios has to be something you would go for 100%. Use any version of one currency, US dollar, pound, euro, whatever, your local currency. You can't use others. You can't trade them. Or trade and spend and consume with alternative currency like Bitcoin for the next 5 years. If you can only pick one or the other, would you rather have your money in fiat currency or alt currency and go for it one way or the other?
I would rather have alternative currency. If this is for the next 5 years, I would rather have alternative currency. If this was for the next 10 years, I'd rather have alternative currency. If this was for the next 20 years, I would rather have alternative currency. If this is till I die, I would rather have alternative currency. I do not believe in fiat currency in any capacity. Every fiat currency has died. That does not mean I think the dollar will die. That's not what I mean. I do believe it loses reserve status, which means I do believe it massively devalues over decades, not over a day. But in terms of this, I would much rather have an alternative currency in silver, gold, and Bitcoin than I would in the dollar. The dollar is historically a depreciating asset class, and commodities are typically an inflationary asset class. Bitcoin has shown strength in the last 2 years, and it has shown strength in the last 6 weeks. And I see Bitcoin continuing to show strength unless something happens to regulate Bitcoin or something happens like another Mt. Gox situation. If those variables do play out, then you have additional risk there that the dollar will never have that type of short-term risk that Bitcoin potentially has in short-term risk. But in terms of silver and gold, I can back with silver and gold, which doesn't have that short-term risk. I'd rather have.
Yeah, and there are so many different avenues to use alt currency. You can buy almost anything you can think of. You might be thinking out there, well, how do I get a loan for my home or a car? You can buy stuff with Bitcoin, and you can secure that with assets and metals. So it's a tough one because it goes against your traditional thinking, but it's not that tough for me and you.
Consumer mindset.
Yeah,
it's not that tough for an investor.
Okay, I got one. Would you rather that your son, who we talked about last week, 16 years old, came to you and said, "Dad, I want to be a trader. I want to be an entrepreneur. I'm dropping out of high school and I'm never going to college"? Or would you rather him say, "Dad, I'm moving to some state and I'm going to enroll in college education. I don't know what kind of degree I'm going to have, but I need the $300K to go through this Ivy League school"? If he can only pick one path, one way or the other, non-traditional or traditional, what would you tell him? What would you pick?
It's an easy call for me. I would pick the non-traditional. I would rather have my son say, I'm not going to college. I'm going to learn to be an investor and an entrepreneur. That would make me smile. That would make me cry a good way. That would make me as proud could be, right? If my son came to me and said, Dad, I want to be a doctor, or I want to be a dentist, or I want to be a lawyer, I want to be this, that would make me proud too. I want my son and my children to do what makes them happy. It's not my role as their parent to tell them how to live their life. It's my role to give them the opportunity of choice. And if those are the two choices, those are both good choices. What I would hope, if I got to pick which one, I would want my son to do both of them. I would want my son to go through traditional education, to get to have the ability to have those experiences, but also learn to invest and trade along the way. That would be the hybrid of the two. But if in the would you rather scenario, I would rather have my son be an entrepreneur and investor than go through 7 years of college education and $200,000 in cost.
That's fun, Matt. I enjoyed it. We're going to take a short break here, after these words from producer Cam, and come back with our last segment of the podcast for the day. Well, actually, two more. We're going to ask a few questions, and then we'll wrap it up. Sounds good.
We'll do them back to back. We'll do them back to back. And by the way, Snapchat is only down 10.65%. It has rebounded 0.5%.
As we talk.
It's a buying opportunity. Let's get out there. Let's buy Snapchat. We'll be right back.
March 7th, 2017. Some really important things happening today. First and foremost, happy birthday, Lizette Morgan. That's my mother.
Hey, Mom.
Also, the Coaches Show was today, and episode 207 will be live on iTunes, Stitcher, TuneIn, and all other major podcast platforms. Give us a 5-star rating and check out some of our older episodes on iTunes. Once again, happy birthday, Mom. Now let's get back for Coach's Mailbag and Clown of the Week.
All right, Tim, we're back with the Trading Justice Podcast, episode 207. We're on to our last two segments of the podcast, and then we'll call it a wrap. These two segments, we're going to go back to back. We're going to do Coach's Mailbag today, as well as wrap it up with a quick Clown of the Week, where we all nominate our own clowns. Now, Tim, we got a few questions from some of our listeners out there, and if you guys want your question read on the podcast and answered, don't hesitate to send an email to team@tackletrading.com. You can always post it in the clubhouse over there at Tackle Trading, or you can always hit us up on Twitter at Trading Justice. Mailbag, hashtag mailbag. There's a lot of different ways. We will pick 2 or 3 of them in most podcasts to go through. And Tim, I'm going to ask the first one, and we'll go on through that. From one of our longtime listeners and followers, Cindy asked, is it appropriate to apply Elliott wave patterns to commodities and currencies, given that they are so directly impacted by global conditions? I track the E-wave in stocks and the ETFs, but can't see how to apply them in commodities or currencies. And Tim, I cannot think of a better person to ask about Elliott wave application than to you, who does not believe in Elliott wave application.
Okay, all right. Do you want the rant or not?
I want you to answer the question.
Wonderful trader, student, saw her just last weekend, came back a year after her first event to come back and say hi to our new students, Matt. Wonderful trader, great to have the question. Is it appropriate to apply Elliott wave patterns to commodities and currencies? Yes, it is. If you use Elliott wave and it has helped you with your, your trading, it's much like they talk about in medicine, the placebo effect. If you believe that it's having an impact, go ahead and use it in any other regard. Elliott wave,
I'm looking at gold right now in its current trend. I got a wave 1, wave 2, wave 3, wave 4, wave 5, and all of a sudden we talked about commodities and it going down. It just so happened to be at the end of wave 5.
Honestly.
Now, were those waves consistent? No, they weren't, according to Elliott wave, but it did go in a 5-wave.
There's nothing wrong with Elliott wave analysis, and I'm sure there's a lot of great technicians that believe in it to their core, and they think it's an indicator and a pattern and whatnot. What I would say to that, quite frankly, is I believe that if somebody has spent years studying something, admitting that it is faulty in logic is something hard for them to do. And so they rely on it as a crutch. And the reality is, I don't believe Elliott wave analysis helps people make money. I think that they could easily make entry points in 9 million other ways. I like to keep it super simple. I don't think you need to be doing wave counts to be able to decide when to buy and sell, Matt. I just don't.
I don't disagree, but I do think Elliott Wave is a wonderful teaching tool to help understand trend analysis and pattern recognition. And, trends don't last forever, and reversal and continuation patterns to end trends. And there's other ways to teach that, but I do think it's a good way to learn how to analyze trend analysis. I think Fibonacci retracements are a great way to identify support. And I think Fibonacci extensions that are tied to Elliott Wave are a great way to identify targets. But so is potential average yield, so is moving averages, so is extended pivots. So there's other ways to do it out there as well. But yes, if Elliott Wave certainly can be applied in commodities and currencies, maybe not to the level that it can in stock. And I think that's what the question is really getting at is it more applicable in a stock, which is independently movements and independently driven, or versus the commodities and currencies when there's so many global things that can impact those. And I would say in where she was asking the question, I would say yes, she is accurate in that. And with that said, silver in its current short-term trend is in an Elliott Wave 4 pattern, so you can expect support to be found somewhere around 1730, and then it go into its last Elliott Wave 5.
I want to create a system that is based on random entry points and teach it, just to prove to my technician friends out there that so much of the chart is simple. And if it gives you an advantage, great, but let's not turn it into a science experiment. That's my only problem with Elliott Wave is it feels like analytics sometimes.
No, your only problem with Elliott Wave is the Elliott Wave technicians have beholden Elliott Wave on the pedestal of all things technical analysis. Like it is the end all be all of all things technicians. That's your problem with it, is when you hear technicians talk like this is some advanced metric that only the most elite of the technicians can analyze and utilize. And yeah, well, he was a guy that wrote a book.
He might have had
That's what he
ketchup on his shirt for all I know. I mean, I don't know this guy. How should we approach a new IPO like Snap? Matt, we talked about this a little bit. In general, new IPOs are good or bad to trade. Angel, Matt will answer this one real short, but Snap, Matt, what do you think?
No, how should you approach a new IPO like Snap? Like the plague. That's how you should approach a new IPO like Snapchat. Like when it was coming out that Chipotle was feeding people E. coli burritos, you probably didn't go there to get a burrito. That's how you approach a new IPO like Snapchat. Right? It's consumer driven, it's hype and circumstance, and it's not based on any form of analysis. It's, I have Snapchat on my phone, and Snapchat trades a stock. Oh my God, I can buy the stock, and I have Snapchat, and I can take a picture on Snapchat of me buying the stock, snap it out to, I don't even know if it's called snap it out, but it sounds good. Snap it out to the rest of my followers, my 38 followers, whatever it is. I don't even know how Snapchat works. I just know that the hype and circumstance do not support the foundation of fundamentals for a stock like Snapchat. And I think you can say that about most IPOs in general, is it's not good or bad to trade them. For me, and the way we approach it, we like to see data. We like to see a little bit of a data. We'd like to see a trend develop. We'd like to see how Wall Street thinks of the stock through technical analysis. We'd like to see more liquidity in the options world so that we can rent them out if it's going bad, or we can buy insurance if it's going good. And so back in the 1980s and 90s and early 2000s, IPOs were almost always gold. People loved them like nothing else, but things have changed. And right now I don't see I see a 50-50 scenario on IPOs right now, and we don't trade like that. So I would say wait for data. And, I already talked about Snapchat. Last questions. A question I have for the community. Seems this is an interesting time to start trading options with the release of Tastyworks. What is Tastyworks? Is Tasty Trade's new broker software from Tom Stosnoff, who has a great reputation on building software. He was also the individual that was chiefly over Thinkorswim as well, which we use primarily. What's your take on it? I've spent years learning TOS, but it looks like Tastyworks streamlines so much and commissions can't be beat. TOS has a much better technical charting and scanning capabilities. Yes, it does. Maybe wait till Tastyworks works out the bugs and hopefully adds better charting. I don't really want to waste my time in TOS if TW is the future. However, there is so much familiarity with TOS. Any recommendations? And I'll answer this one, Tim. Tastyworks, in my short-term evaluation of it, is a great broker software. Does it have all of the bells and whistles and capabilities Thinkorswim has yet? No, it does not have that. But the one thing I do believe that group at Tastyworks can do is build Tastyworks into one of the best trading softwares out there. And for those of you that are wondering Thinkorswim versus Tastyworks or whatever other broker software, we will have some major announcements with Tasty down the road. Keep that in mind. So let's let them work out just some of their processes. And I'm not even talking about the broker software, some of the other things, but we'll have some more information on Tasty down the road. But I am certainly as intrigued as anybody else out there is on what Tastyworks is going to do. Commissions, their commissions are awesome. Their commission plans are absolutely amazing. I actually got the broker software, so I do have it, but I'm still trading with Thinkorswim as I'm learning Tastyworks. And believe me, once Trading Justice or Tackle Trading,
we'll keep
you guys
posted.
will know exactly what we think of it when you see us do something in a coach's show. So definitely check that out over there. That's been the Coach's Mailbag, Tim. And our last segment, we're going to get through this fairly quickly. Our last segment is the Clown of the Week. And before we get into the Clown of the Week, if you have a question for the Coach's Mailbag, again, hit us up on Twitter at Trading Justice. Hit us up on at the Clubhouse at Tackle Trading. Send team at Tackle Trading an email if you want to get your question answered on the podcast. Thank you, Nathan. Thank you, Angel. And thank you, Sydney, for your awesome questions. Clown of the Week. We're changing the format here in Clown of the Week. And what we're doing is we're going back to the original Clown of the Week. And that is we all have a self-nomination for the Clown of the Week, and then we vote on it. And let's start with Tim. Tim, let's start with you and your nominee for the Trading Justice Clown.
This one's a long time coming for me. I could have nominated this man many times, and I understand politics is politics. Jason Chaffetz is a local House Republican, and he is a congressman from here in Utah. He actually is in my district, Matt. Jason, that's who I vote for, that district. And I'll tell you, I'm getting pretty tired of seeing him in the news with all these different things all the time. And I'm going to put him up for Clown of the Week. Just recently, Jason, he went out and said that a lot of people who are going to be losing their health care are going to have to make a tough decision between whether they want to keep their iPhone or get health care, and that's their fault. Now, I understand economics, and I understand cost, but man, that guy just seems to put his head up his ass.
Cell phones are becoming a utility. Cell phones are becoming a utility in American economics. And also, Jason, nobody should ever have to be told that they have to choose between having an ability to contact other people and their health care. That is not in the social contract. Jason Chaffetz is an idiot. He could get nominated multiple times, and I hope the people of Utah are listening to this man just jump circles after circles after circles in not answering why he's not doing his job. And so, yes, I support that nominee, Tim. And by the way, if you have to choose between voting for Jason Chaffetz and your cell phone, choose your cell phone. Tweet out a picture of Jason Chaffetz and everything that he does. Tweet every dumb comment he makes. Or
did you hear about this thing happened to him lately where he had a town hall and he was getting heckled so badly that he just left? Yeah.
He just left. You're a public representative. What are you? That guy has no business in Congress. No business in Congress in any capacity. I support that 100%. Producer Cam, do you have your nominee Okay, I got Cam's. Okay. So Tim, this is Cam's nominee. I don't know if you guys if you've seen this, but it's awesome, right? So this kid, these kids can't be 5, 6, 7 years old, right? And they're just playing on a lowered rim, like an 8-foot rim. They're learning the game of basketball, and one of the kids steals the ball and he starts running to the wrong direction.
Blow the whistle.
And you could hear, yeah. Well, you're hearing the coach just yell, wrong way, wrong way, wrong way, wrong way. And all of a sudden the camera goes to him going to shoot at the wrong hoop. The coach runs out onto the floor and basically just blocks him like who was the guy, the Mutombo waving his finger. So he blocks him like Mutombo. It is hilarious. And yes, clown worthy, no doubt about that. Mine, Tim, is actually going back to politics, and I'm going to go with Democratic representative out of L.A., Cedric Richmond. Now, Tim, I don't know if you've seen this, but the dumbest controversy in political history might have occurred this past week when Kellyanne Conway was taking a picture of Trump and a whole bunch of group of people together. And she took her shoes off, and she was sitting on the couch in the Oval Office with her feet kind of tucked behind her legs, sitting on the couch. You can see the picture of it, and people kind of lost their mind about the disrespect for the office. It was just dumb, and it got even dumber when Cedric Richmond thought he was Cat Williams, right? Going out there joking about it when it was actually his best Michael Richards impression. And he comes out and he says, he basically said Kellyanne Conway looked very familiar on her knees. And just offensive, dumb joke, idiot comment.
Who is the guy?
He actually apologized over it. This guy, his name is Cedric Richmond. He's a Democratic representative from California, from Los Angeles. He's an elected official. He's a Democratic elected official, and he said Kellyanne Conway looked familiar on her knees. And he says in that, he says, I understand that my remarks have been received by many, said Richmond. I apologize to Kellyanne and anyone else who found my comments offensive. Not just who found it was offensive. It's not who may have found my comments offensive. Cedric, it was dumb. It was offensive. It was an idiot comment that should never have been made. Should never have been made in any capacity.
First of all, I mean, the whole thing just screams, not just this guy's comment, the whole thing screams of just a problem with how we treat women. You know, there have been many, many men in the White House who have not had their shoes on, okay? And they've taken their shoes off and wandered around, and we have pictures of this before. But for some reason, there's this woman who is on the couch without her shoes on, and everybody loses their mind that she's disrespecting it. It just
isn't. If that was Laura Bush, nobody would say a damn word. No Democrat, no Republican, no independent. Nobody would say a damn word. If that was Michelle Obama, nobody would say a word. That's Kellyanne Conway, who the Democrats hate. And who's basically the author of Alternative Facts, and she's basically a punching bag for all things these days, and she deserves a lot of it. But what she doesn't deserve is to be humiliated by a Democratic representative Congress telling a woman she looks familiar on her knees. That is ridiculous. That is idiotic. That is chauvinistic. And Mr. Richmond, you do not deserve to be a representative of the United States Congress who talks about women like that. Yes. Stay classy, please. So we got two political nominees in our representative Jason, who doesn't deserve to be in Congress. My clown shoe nominee, Democratic representative Cedric Richmond, does not deserve to be in Congress. And then we got the youth basketball coach doing what some youth basketball coaches do and some youth parents of basketball coaches do, and they acted insane. But we have to vote on one. So let's go producer Cam. Cam, who are you voting for? Okay, Jason Chaffetz got 1 vote.
Well,
Tim,
I would
who are you
love to
voting
vote for this guy talking about Kellyanne Conway, but it just makes me upset. And this one's supposed to be a funny one. Jason Chaffetz has made me upset now for years. I think I'm going with the dad, the coach, blocking the shot.
Yeah.
Because, first of all, it reminds me, nothing that quite that crazy, but I've seen parents act like a fool in a sports setting.
Yeah, I've seen it. I've seen it
and
as well.
It's just funny. It is, in some levels, very, very funny when you see the video, because the kid, he just gets confused. And then he turns. And then all the other kids start yelling at him, and he just keeps dribbling. So cute. And then,
I thought he was dribbling good, too. I thought he had good form. He was doing good form. I've been cheering him on. Good job, buddy. Jason deserves it. Cedric deserves it. Jason Chaffetz, sure. But that's just more of – that's in a long line of a series that we could produce saying when politicians do dumb things, right? So that actually could be a segment. When politicians do dumb things, right? Which is kind of the clown of the week most of 2016. But I got to say, the coach was insane. I mean, the video of that coach yelling, fist moving in the air, running out on the court, and just swatting him like Mutombo. I mean, that's insane. So, do we have a name? Did we get the name of the coach? Let's see. I'm looking at. I don't have the name of the coach, but we're going to give him basically youth basketball coach. Welcome to Clown of the Week. And we'll make sure to get that up on Twitter. Guys, thank you so much for listening to the Trading Justice Podcast. Episode 207 is officially in the books. If you like the podcast, get out there, share it with a friend, share it on Facebook, share it on Twitter, share it on Instagram. Tell your community about it. Help us build this out organically. Also, if you love the podcast, we really appreciate any iTunes reviews from you guys. It warms our heart to go out there and read those.
This has been the Trading Justice Podcast. Give us a like on our Facebook page and click on the link that takes you to tackletrading.com to download the 7 Steps Guide to Trading. That's your comprehensive guide if you're a new investor or trader to think, logically through the market and make decisions. Thanks for tuning in. We'll be back next week with another spectacular show, but until then, catch up on shows you could have missed, and we got a whole library of them over at tradingjustice.com and iTunes.
Music for episode 207 was brought to you by bensound.com and purpleplanet.com. We really appreciate it. Next week, y'all.